Well, hello everyone, and let's talk a little bit about a sensitivity analysis. That analysis is really an extension of our analysis of the internal rate of return and partitioning the internal rate of return. And this is just a logical extension of both of those analyses. What a sensitivity analysis does, it is a process of changing variables once at a time and judging what the impact is on the overall return of the project. So that's what I'm going to do here with you. I'm going to show you how that is done. It's really quite simple, but people get a little bit worried about the math involved, but there really isn't that much. You don't have to worry about that. So let's just go through it right now, and I'll show you how a sensitivity analysis works. And I do want to emphasize the fact that a sensitivity analysis is a very important step in my analysis of various properties, because I know one thing I'm up against is when I'm making a presentation to the investors or the investment committee, they all want to know what happens if. That's why I do these sensitivity analysis. It gives me an idea of what will happen if we are unable to meet the goals or the assumptions that we have built into the project. Okay, let's take a look. Hello everyone, and welcome to my third installment of a discussion of the internal rate of return. Just to summarize quickly, we put together this investment model and then built a number of assumptions into this, and we found out that, just moving down here, that this investment would result in an internal rate of return of 11.31%. But we were interested also in looking at where is that return coming from. And what we did was we partitioned the internal rate of return between its components. That internal rate of return is made up of income from cash flow, tax benefit, and appreciation. And we ran through the calculations and found out that the bulk of the return is coming from appreciation. And it was appreciation made up 94.86% of this number, which equates to appreciation made up 10.73% of the 11.31% internal rate of return. What that means is, since it's such a high percentage, this investment is back-end loaded. When that happens, I just know that investors are going to be asking me, what happens if we don't meet the assumptions which are built into this model? What happens if we don't have the increases in rents? Or what happens if this type of investment becomes less attractive and people are willing to pay less for it, which would drive up the cap rate? Or just the opposite? People start to like this investment much more. There's a greater demand. People are paying more, which means the cap rate goes down. All right, that is the scenario we're dealing with. So the way I handle it and the way I can answer those questions to investors is I construct a table which shows these various scenarios. And that is done, it's called a sensitivity analysis. And I've set one up here for you. What we've decided to do is look at those elements which would have the most impact on appreciation. Two of those elements that we want to concentrate on: the cap rate and occupancy. A change in either one of those would have a major impact on appreciation, this part of the return. So that's what we do. Looking at this matrix, then the model was constructed based upon occupancy levels of 97% and a cap rate of 4.55. And I'll just show you that real quick here. This is where the 4.55 came from. That was the cap rate at which this property was purchased or to be purchased. And that means that the most likely scenario is a 11.31% return. That's the most likely. And so that number we plug right here in this one. 97% occupancy, 4.55 cap rate. One of the benefits of having a model like this is you can now go in and change these assumptions one at a time and look at what the impact was on the internal rate of return. So for instance, I want to know, keeping the same cap rate here, I want to know what happens if the occupancy is only 85% occupancy, which means a 15% vacancy. Well, in the model, I can go back up here and I look at the vacancy number we plugged in. I think it's best to keep vacancy in the first year at the same level at which we purchased it. But let's say by the second year, we're doing a terrible job, can't keep the occupancy levels up. In fact, the vacancy runs to 15%. I'm going to change this number and copy it over here. All right, now let's just go back down and look what happened to the internal rate of return. In that case, the only change we made was occupancy, and the internal rate of return fell to 0.62%. And I'll plug that in here. 0.0062. That's the process we follow when we're constructing a matrix. And then, so the next step would be, let's just change the occupancy and say, well, we're doing a fantastic job and we maintain 100% occupancy during the full 5 years. Not likely, but let's make the change. Okay, so at that, I'll keep it at 3% for the first year, but after that, we're doing a great job and there is no vacancy. Now let's go back down and look at the internal rate of return. In that case, again, maintaining the same cap rate at the end of year 5, then the internal rate of return is 13.47%. Okay, you see the process again? What this is, I'm going in and changing the assumptions one at a time. Now, for the next one, what I would do is, well, I'll go in and make the changes for, let's say, worst case scenario. The demand for this type of property actually falls. People, they just don't want this type of property. The overall demand for the property goes down. So what happens? If there's less demand, people are willing to pay less for each dollar of income from the property. The prices drop, and as a result, the cap rate goes up, inversely related to the price. So I can go ahead and make that change and then run the numbers at these various occupancy levels and see what happens. And I can also do the same thing. Let's assume that the market turns really great and there's a huge demand for these type of investments. Huge demand bids the prices up, the prices go up, and the cap rate goes down. So I can run all those scenarios at that various occupancy levels. In fact, I'm going to go ahead and do that right now, and then I'll show you the numbers. I have now gone ahead and calculated all the numbers, and here they are in this matrix. And the results are really quite interesting. First of all, just to kind of summarize this, our most likely scenario was this property will result in a 11.31% internal rate of return. And then we looked at that at the various occupancy levels. As long as we can maintain the cap rate at the end of year 5 at 4.55%, then these would be the range of alternatives here. And the internal rate of return would go, if you had just a 85% occupancy, which is not bad, that's good. But at 85% maintaining the same cap, the maximum return you could have is 0.62%. And then we talked about the most likely. And then in the best case scenario, if you had 100% occupancy, the internal rate of return would be 13.47%. Well, that doesn't sound too high to me for best case scenario. The best case with the most likely cap rate. Okay, but look at these others. We had a fantastic market, and when we went to sell this at the end of year 5, the cap rate goes to 3.55%, which means This is a very attractive investment. The investors are willing to pay more for each dollar of income, and as a result, that drives the prices up. The cap rate goes down, 3.55. Looking at the returns based upon the occupancy, it ranges from 12.15% all the way up to 23.19. Now looking at the worst case scenario, if I change the cap rate at the end of year 5 to 5.55%, then look at the range of the internal rate of return based upon the occupancy levels. It goes from a negative 11.24% up to 4.77% at 100% occupancy. We know that won't occur, and that really, if the best an investor could take if the cap rate went down, the prices go down, cap rate goes up, 2.25%. Or if you just occupancy levels drop to just 85%, what? I mean, think about that. So anyway, this is, I really recommend that all investors look at something like this, construct your investment model, and then run the numbers, changing the assumptions one at a time. That's all I've done in here. And again, this can be quite an eye-opening experience. Alrighty? Well, if you would like more information on putting together a sensitivity analysis, I put that in the blog, and it goes into a more in-depth discussion. And also, if you wanted to get a very in-depth discussion, you might want to consider taking my course, Real Estate Investing for Everyone, where I go through exactly what all these calculations are and how to do them, and how to construct, as a matter of fact, the entire investment model. Okay? Let me know if you have any questions. Thank you.